Hello, welcome to Money Talk Viewpoint, a financial education podcast that's geared towards financial professionals, high net worth individuals, CPAs, and people that service the virtual family office. My name is Stuart Cruz. I'm going to be your host today. I'm the founder of Cruz Asset Management. We're a boutique financial asset management firm and virtual family office. We make all our investment decisions using math and statistics. And if you don't know what a virtual family office is, it's a team-based approach towards optimizing our clients' wealth using over 80 plus professionals on our platform to bring them in as a team. Wouldn't you rather have the team working on your behalf than the team competing for your wallet size? No, you want everybody working together in cooperation for you. So that's the newest model that's out there. We think it's fantastic. It's been extremely helpful to our clients. So I'm super excited to have our first guest on our show of 2025. John, I'm going to kind of butcher your name. Can you tell me it's Cascarano? Cascarano?
That's it. You got it. Yeah, just good Italian name. So just like it's spelled just like it sounds.
Sounds good. All right. So, John, you're a graduate of Michigan Law, which is actually where my wife went to school. So you're a smart cookie. I never win an argument at home. So I guess the only argument I can have is not to have an argument. That's the only way I win. You were member of the Endeavor Law Group, where you focus on entrepreneurial legal strategies and commercial real estate. And you went on to found Blue Metric Group, which is what we're going to be talking about primarily. But since you are wearing this Duke hat, your undergraduate Duke degree in English, I am really sorry for your early exit from the Final Four. I know usually, making it to the Final Four is pretty much a feather in your cap, but I know your team had higher hopes this year. So
Great team. Yeah, it was a great team. One of the best teams I've ever seen, which is obviously saying something. I was a 2001 grad, and they won nearly 2 national championships when I was there. But it was one of the top 3 most difficult losses when Coach K retired, and the last game he lost to UNC. That was a tough one.
Yeah,
Back to the UConn in the Final Four like over 20 years ago, and then man, this one. But great year anyway. But yeah,
great
tough.
year. It's hard to say when you make it to the Final Four that you came up short, but yeah, the hopes were high for you guys, right? So, any insight on what Cooper Flag's going to do with the Boozer twins coming in? You think is he going to the draft? Is that what's happening?
I think so. I think he should. Yeah, I think he should. There's so much for him. That's what I think. Obviously, Duke would love to have him back, but I think he'll probably go.
For sure. All right. Well, enough about Duke. Like I'm sure a lot of people in the virtual family office space don't really watch NCAA basketball. And I went to Northwestern, so we've made it to that tournament twice in the history of the school. So not great representation there. I'm super interested. While you're at Duke, it says you're a founding member of Mental Floss magazine. So that's interesting. Tell me how that happened.
Yeah, so I've always been entrepreneurial my whole life, and when I was in elementary school, I had a little bracelet business. So this goes way back. So my dream was to go to Duke. Duke basketball is relevant because I watched Christian Laettner and that whole team win it, and I want to go to Duke. I set my sights on that, got in, and once I was there, in freshman year I met two other guys in the freshman dining hall, and we created a business. The one had this name, Mental Floss, and he wanted to do a series of books, just general knowledge books. And this other fellow said, well, why don't we do a magazine? We could do that on campus. And I was like, well, I'll help write it and help get money. And we funded it by getting grants through different departments on campus, because every department has unused money. And we figured this out, and we're like, wow, if we get a sociology grad student to write an article, they'll give us $500. And that's how we funded the magazine.
Really?
And then it actually turned into something.
Yeah.
And, it eventually turned into after school, we worked on it, turned into a good website, a general knowledge website. That was it. The mission was to make people feel smart again. So that was it. It was and we did, actually my wife and I wrote a law school in a box, and it was in Barnes and Noble. I think it's still there. We wrote other stuff and we did board games, and it was eventually bought by the founder of Maxim magazine, Felix Dennis. He acquired it. So that was my first taste of an entrepreneurial endeavor.
That's fantastic. Well, obviously you've always been entrepreneurial. So tell us, let's jump into the meat of it. Tell us how you've gone from being an attorney to founding Blue Metric.
Yeah. So, after that, I went to law school, Michigan, as we discussed. My wife went there too. So unfortunately, I have a hard time in arguments as well. But I had, practice in a big law firm environment doing commercial real estate law. Um, and later we had moved to Nashville. She had taken a job at Vanderbilt Law School. So I started my own firm and had a client buying mobile home parks. And number one, he was doing really well. Number two, he kept talking about depreciation and the tax advantages and how he never paid taxes. So I started learning, really just researching it. And then I started saying, hey, I'd love to invest with you. Like a lot of professionals, we have a lot of dentists and doctor investors too, and some lawyers. It's just, you bill by the hour. It's difficult. I would get carpal tunnel, my shoulders would hurt. And I'm like, man, I want more than just to bill by the hour. I want to build wealth.
Right.
It's hard to do that off your hourly rate. So, I was looking for an investment. My wife and I were looking, and the client actually got an RV park under contract. And he brought it to me and said, look, you've been asking to invest with us. We don't, he had a big family behind him. He's like, I don't need investment, but why don't you look at this? It's different than mobile home parks. The management's different. So we're not going to buy it. Why don't you look at it? If you like it, take it. And I looked at it, researched it, and my wife and I and a dentist, we bought it together, and it went really well. So year one, we took a huge loss. It was over two times our capital invested as a loss, and it's still cash flowed. So it cash flowed really well. So we had like double digit cash on cash and a huge tax loss. I'm like, this is the greatest thing ever. Let me look for more.
Yeah.
So that's what I did. And then I was like, well, we can't do this with only our capital. Let's start raising capital. And we went a normal path, friends and family. And then now we've raised a good bit of capital, all from accredited investors, and the tax benefits are a big selling point. And I could talk about why, but mobile home parks and RV parks are really kind of best in class when it comes to real estate investing and qualifying for bonus depreciation.
So let's jump into this a little bit. Like obviously we have dozens of tax strategies, and some of them, work really well. Not to sell another aspect, but we have this oil and gas strategy that throws off dividend strategies, and it works really well with real estate investments and depreciation and passive losses. So you get a huge 93% tax deduction in that investment year, and then you start getting dividends, which you can match up against passive losses of real estate depreciation. So this strategy would go hand in hand with them. Um, Tell the listeners a little bit more about this. How can you invest X and get 2X loss on this? Like, how does that work?
Yeah. Yeah, and that was back that was 2022. That it's basically tied to the ability to accelerate depreciation, or aka bonus depreciation. So
Let's
certain
spell that out. So
assets,
is that like cost segregation studies in regular real estate? So let's spell that out for some of the
yeah, and probably a lot of people have heard about this or know about, but um, certain assets, basically anything with a 15-year property or less, you can accelerate and take a certain percent of that. Back in 22 it was 100%. Then it was last year it was 60. It was gone 80, 60. This year it's 40, unless Congress bumps it back up to 100%, which there's serious talk. That was one of the things that, President Trump wanted to do. I think it's pretty likely, which will make this asset class really attractive for this reason. But the gist is any 15-year or less property, you can accelerate that and take it year one. So this year, as of now, we could take 40%. If Congress re-ups it, it could become 100% again this
Wow.
year of that property. You can accelerate that. That creates a big loss year one that we pass. It's partnership taxation, so the loss just passes through via K1 to the investors.
Yeah. It's an
And we
amazing
do, yeah,
benefit. So then on the other side, and again, if you hear, hey, why do I want a loss? I invest X number of dollars, I take this big loss, but the other side of this is it's cash flowing really well. So let's talk about some of the cash
Yeah.
flow that you get. And why don't we throw out like a case study or some sort of example? If somebody were put in $100,000, what is a, I'm not saying it's obviously not guaranteed, but what is a typical kind of deal that you see?
Yeah, yeah, that's probably the easiest way to break it down. Yeah, so typically typically we're buying these parks. We'll use a mortgage. So we identify a park. Let's just say it's 10 million. Let's say the purchase price is 10 million. Um, and we're like, all right, it's a great deal. It goes through underwriting. We're looking at a lot of these now. So I don't know if anyone's looking at more deals than we are, but like any real estate, you got to look at, 100 deals to pick one or two. And you find one, all right, 10 million, we like it. We'll put about 30% down, um, roughly 30 to 35%. We'll have a mortgage, and which means we need about 3 to 4 million equity. Call it 4 million.
Yeah.
Well, so okay, so we need 4 million. Then from there, well, how much depreciation is there? Well, if it's a $10 million property, first you determine what the land value is. So you scrape off the land value. So let's say, and because RV parks, they're not down, it's not downtown Nashville where I am, or Chicago,
Yeah.
or wherever. It's typically out in the country, usually we like there to be some draw, like a lake, river, state park, national park, something that brings people there, and people stop there and or live there. So uh, usually land values though are not crazy expensive. So we could defensively say, let's say the land is 20% of that 10 million. We'll say we'll prove, we'll have backup. All right, 20%. All right, that leaves 8 million. 8 million is other value. Well, what is it? Well, it must be the stuff on the land and in all the improvements. So all that stuff is depreciable. So there's 8 million. And then on that, we get the cost segregation study where, third party firm comes in, they look at it, it's engineers, they'll send someone there, uh, they'll break down and they'll try to find as much 5 and 15 year property as they can. And usually RV parks just do really, really well, at 5 and 15, a lot of 15-year property. It's all the infrastructure. It's not a lot of 27 and a half year, 39-year buildings. It's wiring, it's concrete, it's all that stuff. So that gives us typically a lot of that 8 million is depreciable and qualifying for bonus depreciation. And so whatever the cost seg spits out, we multiply by that 40%, unless Congress brings it back to 100%. So it works out to, it might be about, call it 2.5 to 3 million. Let's say 3 million. Well, that three, and then that goes right to the LPs first because they have basis. So if we have 4 million in capital and 3 million in uh, uh, loss from bonus depreciation, qualifying improvements, then you take the 3 divided by 4, it'd be about 75%. I usually don't tell people quite that much. I usually say, this year with the tax law, it is expect maybe, 40, about it almost equates to where the mortgage is, ironically, is about what the percent loss on 100. So so this year, tax law doesn't change. You get about a 40K loss right now on a typical property.
Okay, so you put in $100,000, you're part of this fund that you're
Mhm.
buying, and you get that 40K loss.
Mhm.
So net, the investor is out $60,000, or $60,000 has to go out of his pocket,
Right.
after tax. So then what is he going to expect on the return side?
Yeah. So we're buying from there. We're underwriting these just as we're looking for cash flowing investments. Just there's cap rates. Anyone in real estate knows all this stuff. We buy existing RV parks and we're not developing new ones. So we want ones where we look at the seller financials. We try to get, 3 years or more, whatever we can get. There's a bank looking over our shoulder underwriting, and they're looking at the income too. It's debt service coverage loans. So they want to see a certain income. So we want stuff that ideally cash flows day one.
Yep.
And we'd love there to be some value add on top of that too. Like there may be extra land, there may be room to bring the rates to market or do other things. We have a whole playbook at this point. We have 27 RV parks now, so we've kind of done this before, but we ideally what we want to be able to distribute at least in that 8 to 10% cash on cash range each year, and we distribute quarterly. So we want to come in, buy it, and within a quarter or two start distributing at that 8 to 10% cash on cash. And then the strategy with the value add, the strategy is really the BRRRR strategy in real estate: buy, rent, rehab, refinance, repeat. So we're coming in, we're buying it over that first year. We're going to do some stuff to increase the profit, and then show that over 24 to 36 months, do a cash out refinance. We're really kind of proving it to the bank at that point that they deserve to give us a bigger loan. And once we get that, we distribute that back out to all the investors. And hopefully the target is to return most or all, certainly more than the 60K they're kind of net out. But and they'll have gotten distributions over that time. But we want people to, by the time we get to that 24 to 36 month period, distribute out more than what they've invested. Now everyone's in the green. Everyone's still in the deal. No one's cashed out. You're still in. And then we just hold it as part of the portfolio.
Yeah. And so I'm going to reiterate. So you're buying existing RV parks. So there's not hopefully a lot of surprises. You understand what the cash flow is because there's years of history there anyway. And you're looking to make material improvements on the site to improve this so you can get better loans. For those of you who don't know, like, you want to explain cash on cash means?
Yeah, that's what I care a lot about as when I'm have my investor hat on. It's just, you invest a dollar, what are you actually getting back distributed to you in your bank account, cash? So if you invest 100 grand, you know, if you get 10 grand that year, that's 10%.
Yep. Okay. And so you're looking to get that return, the first turn of capital, you said in the first 24 to 36 months, to 2 to 3 years, you're going to get back. And now the investors net flat, and now they're getting cash flow. They've received this great deduction. They're getting now cash flow. And how long does this traditionally go on? Like, how long is the deal?
Yeah, we're really building a portfolio. So the end game is to target an institutional exit to PE, or potentially going public ourselves. Go public or get bought, in short. And we know once the portfolio, we're at about 150 million in assets now. We get to 250, 300 range. The Apollos, the Blackstones, they're interested in that portfolio for sure. We know we've had the conversations like, what would you want to buy? And they've told us. And at that level, there's a good scale where the portfolio is really nicely self-sustaining. So we're really in the driver's seat. But we're assuming about a 5-year hold. I mean, I think it'll probably be a lot less. Just this sector, for various reasons, I think the sectors is consolidating, which is, there's also this macro consolidation going on. And if we have a nice portfolio, we'll be in a nice spot to get bought.
So let's talk about, like, there's a lot of real estate that's out there, right? I have people calling me, hey, I need to buy homes in Breckenridge and I need to do XYZ and I need, seems like no brainer. So talk about how RV parks, where they sit relative to other real estate deals, and what are the advantages and disadvantages versus other deals somebody might be able to get into.
The advantage is you can enter often at a higher cap rate, which equates to a higher multiple on the net operating income than a lot of other classes of real estate. Mobile home parks, apartments, self-storage, these have all been these will trade at lower cap rates than RV parks. And part of the reason is just managing them at scale. So that's been the challenge for anyone trying to do this. And I spent a couple years building our own management company to do this ourselves and manage at scale. And that's hopefully obviously another selling point to the institutional buyer down the road. But as compared to other classes, you can get more bonus depreciation and enter at a higher cap rate than other classes.
So do you find, are there indeed synergies for managing, what do you said, you have 27 parks right now? Is that what, so are there synergies having one management style company that's in place, or at least the platform or system in place versus somebody trying to do this on their own?
Yeah, and I would it would be it was very difficult around park number 5, 6. That was where almost like other business, one of our investors owns a number of dental practices, and we talked often, and he's an advisor, and he's just, it's very ironically similar to any other business. You get to a certain size and you need to start adding a corporate structure and above it. And that's really what we have. Like if you're a lot of these are mom and pop owned too. So they're owned by a family for a while. They've run it themselves. A lot of times they work very hard, and they want someone that will carry on what they're doing, but hopefully do it with the benefit of a team. And we have district managers that oversee, typically around 5 parks, and then above them we have a key, a small executive team that we run on EOS, which is a business operating system, and
Yeah.
we have some because of the scale, we're able to have a little redundancy of some personnel. If something happens, we have people that could, if a park manager leaves, imagine a Chick-fil-A or McDonald's or something, you lose a manager, it's a problem. If you don't have people, we have people at this point that could step in, and then there's some other efficiencies too, just the same things we do over and over. And then we're also have portfolio insurance, so we have some advantages and cost savings there over an owner operator.
Yeah, you mentioned the EOS is not like a business operating system. What's the book? Is it What is EOS? And then Traction, I think, is out there. Those are
That's right. Yeah.
read on that. These type of systems are, they're pretty great. So if you're interested in how to run a business and scale, that's a good start.
Yeah. And I was a member of EO Nashville Entrepreneurs Org, and I learned about it there, and I was like, man, I wish we had run Mental Flow many years ago. I was like, man, we would have expedited our growth if we had just adopted it earlier. But it's a good system.
Yeah. They talk a lot about KPIs and stuff in there. So like what would be your key performance indicators for an RV park or something to make sure that they're operating? And that dovetails into another question I was going to ask, which would be about risk management. So
Yeah, well, I mean, I say it's an NOI game for us, and not net operating income is obviously the big one. With profit, EBITDA is a big
yeah.
one. But we look at average daily rate is another one we're looking at, and we're looking at occupancy. Just we're looking at debt service coverage.
Mhm.
The managers have and districts will have their expense line items. Their expense ratio is another there. And then, customer satisfaction, just reviews, online reviews matter a lot for these parks.
What are the big risks of it? Somebody, I've got, let's say I have a client said, hey, this sounds fantastic. I'm going to get all this tax depreciation benefit. I'm going to get cash on cash in the 8% range. I love it. This deal is going to go on until there's a liquidation event, hopefully 5 years down the road or less. Then we get our payout. What are the risks that they should be concerned with and aware of?
Yeah, almost like any other property, it's inflation it's been put some pressure on expenses. I'd say that just market forces. There's uncertainty out there. Luckily with RV parks we can mitigate that some. We're also playing this game sometimes of longer term occupants versus shorter term. So some parks are more transient, we call it. It's like almost like a hotel. They come, if it's near a national park, they're really there to visit the national park. So they may be 2 nights. You could charge more, but that's where the average daily rate comes in. We're trying to maximize that however we do it. But some of these, if the market, that particular location goes a little soft, we start leaning more to longer term or monthly tenants where it's almost like an apartment building where they'll pay a certain amount each month to stay. But though, there is some certainly market forces there, what people can afford. If people are traveling less domestically, after kind of like well, during COVID there was actually a boom where it was
Yeah.
in RV parks because you couldn't go to a hotel or anywhere, but you could certainly be outdoors in an RV park. So that was actually good for the industry, even though it was bad for other industries. But I'd say, a lot higher, significantly higher gas prices can discourage travel. That could impact. But most of it, it's, kind of in that P&L range. Expenses get higher, your revenue, that's kind of business risk is the main one. And then, sometimes there could be some random things like natural disasters. We have insurance, but even so, one park near Nashville. Nashville's prone to flooding. Where I live in Nashville, and one park recently had a flood, and it luckily it didn't cripple the park. I mean, it took about 10 out of 104 sites. It took 10 offline, so we'll have to repair those. And then, do you do an insurance claim or not? Is it worth it? There's some of that. We've tried to avoid being right on the coast. But there's definitely some weather, natural disaster risk too.
Sure. What are the trends in that space? I know, like, she's during COVID, I had so many clients, friends, associates that I'm going to go buy an RV, and somewhat ironically, we jumped on that early in the sense, like, everything shut down in March, and in April we went and got a Airbnb somewhere. It was in Tennessee, and then went to Virginia before anybody was really traveling. So it was like deserted on the highways and streets, but then people are like, hey, we can start traveling. What are the demographics now that COVID has passed and we're kind of
Yeah.
leveling out?
Yeah, it's definitely, you had a 21, 22 were very up years. Overall, there's an uptrend. So overall, you're seeing, obviously you have a huge retiree set. This is their lifestyle. This is what they do. Boomers, this is what they do. And some very wealthy people have $1 million motor coaches, and we have some parks they stay at, and we've had some of those folks invest with us too. They're like, oh, this is great. Where are your parks? I'll stay at those. But there was like 23, 24 last year. There was a kind of a downtick, and then we're kind of leveled off. Overall, we're still kind of within that uptrend, but after, right on the heels of COVID, they boomed and kind of went below, and now it's, back, really reverting back to the trend. Younger people, you can see the appeal though for younger people if, one of the number one things we do at any park is make sure the Wi-Fi is good.
Yeah.
If you're 25 and you're out of college, you're working and you're remote, you could be at Glacier National Park one day and Mount Rushmore a couple days later. So and work each day. Just log on your computer. So there's kind of a surprising stability, and it's nice to see younger people get into that into the lifestyle of it. So I think it's not just like the boomer set that's driving it, although they will for a while, but it's younger people too.
Okay. How do you think, you said it was pretty fragmented, mom and pops own these RVs. Are there other people doing what you're doing, and how does Blue Metric, differentiate themselves?
Yeah, there definitely are. I'd say I've seen, and I'm part of a real estate group too. There's 50 people in it, and there's two other fellows like me, but nobody's managed to keep the momentum that I've seen that we have. And I talk to the other operators too, because when the exit comes, and number one, I like looking at their portfolios when they're ready to sell. So there's a couple of them I just check in with them. Hey, how's things going? Number two, some of them sometimes they'll have maybe a family office investor, but they're maybe sometimes a little handcuffed too, because that's it. They'll buy it, the family office's cadence. I don't think nobody that I know of has bought more parks than we have over the last 2 years. And I think if you're just getting started, it'd be difficult because you'd be competing with us, and we could, the management of it at this point. But there's a couple others out there for sure. Like if it's good and worth doing, you have competition. But it's kind of like a semi-friendly because I want to stay close, because at some point it may be like I pick up the phone and say, hey, so and so wants to buy us. Do you want to include your portfolio with it? And that could lead to a higher, hopefully, exit valuation. Yeah.
Yeah. What's like your best profile of an investor that would come inside? Obviously, this is geared towards high net worth and family office. So what's like your ideal profile?
Yeah, ideally they like the loss. We know we could give them that. So that if you have gains you need to offset, great. Right there, it's a win. And then from there, just kind of on board with that, the timeline of what we're doing and the kind of the cash on cash distributions, just as we laid it out, if that's attractive to you. But if you know you're using that loss year one, it makes it, I think, really attractive.
Yeah. So you said there depreciation in that year one, but there's continued depreciation over time. Is that right? Yeah.
Yeah, yeah. So the remainder there will be some year two and three for sure. Whatever we don't use. And if we do some improvements too, we could pick up some. Sometimes we do things like adding sites, which are, qualify really well for there may be 5 year property, but we got to use up the remaining of those 5 years. Sometimes we add tiny homes and just depending, sometimes those. Um, Qualify really well for accelerated losses. And so yeah, there will be some lingering so sometimes year two it could be somewhat equate to what you get distributed, just depending on what we do at that park.
Okay. And I think you said it, but I just want to reiterate. So future plans of your fund and how many, I guess, tell us that there are two, how many funds do you have and like, what are the future plans of these funds?
This is the second fund. It's really for what we buy this year, and we're trying to close on one. We're entering the high season, so it's a really good time the next couple of months, so because we're buying as the cash flows, like they're cash flowing, we're in the high season. And it's also motivational to sellers because if you own a park and you're 7 years old and we can come in and take it over quickly, sometimes that's very attractive for some good assets to a seller. And we could say, look, we'll close. We have a great track record and we'll manage it like you managed it and be a good steward of what you've created. So this is the summer. We'll close pretty actively now through into the fall for sure. So they'll be like our next acquisition is one right near Mount Rushmore, which is a nice park.
Yeah. And so you're hoping that the investors here, they get their depreciation, they got cash on cash, and then 3 to 5 years, you sell to a private equity firm, take it public yourself, something along those lines. And there's a distribution and you said, rinse and repeat.
There you go. That's right.
I like it. Well, that's a good place to stop because it's an extremely attractive tax mitigation strategy and, ongoing cash flows. So tell the guests how we can get the viewers, how we can get a hold of you.
Yeah, my email is john@bluemetricgroup.com, john@bluemetricgroup.com. And yeah, email me anytime.
Okay.
I'd love
You
to
can
chat in
get to
our
John.
park.
Yeah, you can get to John through me as well. We can be reached at cruiseassetmanagement.com or Stewart@cruiseassetmanagement.com, KRUSE. We also have a YouTube channel at Cruise AM, and you can find me on LinkedIn at Cruise AM as well. You've been watching Money Talk Viewpoint. This is the podcast geared towards high net worth individuals, family offices, CPAs, and those who service them. If you're interested in becoming a guest on Money Talk Viewpoint, please reach out to moneytalkviewpoint.org. I've been your host, Stuart Cruz, and thanks for watching. It's been a pleasure to have you on the show, John. Really appreciate your time.
Thank you. Thank you, Stuart.
All right. Don't forget to be better every single day.